AutoZone is a retailer and distributor of automotive replacement parts and accessories. Company stock price declined by about 22% since reaching all-time highs in mid-September this year. 7% of the market value was lost when AutoZone released its quarterly financial results on December 9th. But this price decline might be the news that investors were looking for. Let's investigate the business further and find out why I say so. AutoZone is profitable and stable business, which started as a single store in 1979. Now they sell products online, operate 6,666 physical stores in the United States, 895 stores in Mexico, and 149 stores in Brazil, and are constantly expanding store numbers in all of these countries. Revenue in the past year has reached $19.8 billion. Revenue has been growing every year in the past 10 years, with noticeable increase during COVID pandemic, when demand for AutoZone's products increased significantly. Net profit in the past year has reached $2.6 billion, with a margin of 13%. Stagnating net profit was influenced by higher product and operational costs. Major KPI to evaluate AutoZone's performance is sales per store. In the past year, numbers have worsened. First of all, sales per store decreased for the first time. Also, product and operating costs grew on a higher rate than the revenue, which carried the negative impact on per store numbers. 2025 was a slower year for AutoZone in terms of profitability, but let's see what the management is doing with those profits. First of all, let's take a look at AutoZone's free cash flow. During COVID, free cash flow peaked as profits expanded, and company couldn't deploy enough capital for new store openings because of various restrictions. But since then, we see ever declining free cash flow, mainly influenced by increasing new store openings. Historically, company has been opening 200 stores per year. In 2025, new store openings climbed over 300 for the first time, and by 2028, AutoZone plans to be opening 500 stores a year. This will have negative impact on free cash flow as massive investments are planned ahead. This year alone, company will spend $1.5 billion on that. But management sees big growth opportunities, especially in Mexico and Brazil. Two main metrics AutoZone looks at before deciding to open a new store are average miles driven and average age of vehicle park. They target 7-year-old vehicle parks, and in US, the average vehicle is around 13 years old. In poorer countries like Mexico and Brazil, vehicle parks are even older, which is great for AutoZone replacement parts retail business. AutoZone also owns 5% of market share in commercial segment, which is a $100 billion market. AutoZone failed to capture more market share in this segment in the past 5 years, but they intend to change that now. The question arises, are such investments worth it, or this is a money sink for investors? If we look at AutoZone's return on invested capital metric, it's been hovering around 40% over the 10-year period. Even though it declined to 37.5% as of now, I'm more than happy to see high capital employment when numbers are that good. Moving on to free cash flow allocation, I like that company decreased amount of money spent on share buybacks and used 41% of free cash flow to repay some of its debt, which is pretty high already. AutoZone constantly repurchases its shares from the market, and this is their main way to return value to shareholders. Over the 10-year period, shares outstanding declined almost in half. Company never paid any dividend. When interruptions in growth story meet high stock valuations, the result is a sharp price decline. This is what we are seeing now with AutoZone stock. We talked about future possibilities and the reasons for increasing rate of new store openings, but what are the risks? From a business perspective, there are not that many. Company thrived during COVID, management navigated recent tariff uncertainties, and in general, company successfully navigated various situations during 46 years of work with global technological and economical changes. We can point a finger to AutoZone's high debt level, but for such stable business it's not uncommon. I believe that this business will stay a great business many years from now. The only risk for a potential investor is acquisition price. According to my calculations, there is value in purchasing a stock when it's below $3,000. And if one could grab it at 2,500, that would be very attractive for my standards. In 2025 annual letter to shareholders, AutoZone's management mentioned that they expect some profitability pressure in the short term, which means that the current price trend reversal could last. This can open up opportunities for investors with long-term perspective, and this is why I'm happy to see stock price finally declining. Currently, I'm bearish on the stock price and would hold on to my money while monitoring the stock for cheaper entry points which are likely to come. If you have something to add, I'd like to see your thoughts in the comments section below. Thank you for watching. If you found this analysis useful and if you're looking for more investment ideas, subscribe to my channel. I'm Aurimas and these were my insights. Stay curious, stay disciplined, and may your returns be strong.